All right, so picture this with me, right? It's 2008, and the financial world, well, it's starting to sweat, like really sweat.
Yeah, things weren't looking so good.
Not good at all. And then, bam, Lehman Brothers, a name everyone on Wall Street and probably even your grandma knew, collapses.
Just like that.
We're talking total financial meltdown, the kind of story you'd think was ripped straight from a movie. And trust me, whether you followed the markets religiously or just saw the headlines and thought, what the heck is a Lehman Brother?
Girl, this deep dive. Oh, it's a wild ride.
It really is a story for the ages, this one. Risk, ambition, you name it. It's all the ingredients for one epic financial disaster.
Exactly, it's like financial Jenga, but on a global scale.
Ah.
But before we get to the collapse, Lehman Brothers, they had quite the history, right? I mean, they weren't always on the brink of collapse. Oh, not at all. Not at all. We're talking way back the 1850s.
Wow, okay.
Yeah, they started out trading cotton. Down in Alabama, actually.
Cotton. So not exactly the Wall Street image we're all imagining, huh?
Nope. Very different world back then.
Talk about a transformation, though, right? From cotton fields to global finance? That's incredible. And they were a major player for over a century, even surviving things like the Great Depression.
Right. They had some serious staying power.
So what changed? Why are we here talking about them in the past tense?
Well, rewind to the early 2000s. Housing boom, remember. Everyone and their cousin was buying houses. Interest rates were super low.
Ah, yes. I'm starting to remember those days.
And Lehman Brothers, well, like a lot of financial institutions at the time, they dove headfirst into this thing called mortgage-backed securities.
Okay, hold on. I think we need to break this down a bit. Mortgage-backed securities. For those of us who don't speak fluent finance.
Right. So imagine a giant fruit salad, okay?
Okay, I like where this is going.
Each piece of fruit, that's a mortgage. Some are apples, some are oranges, some are a bit riskier, like maybe durian fruit smells a bit funky, but some people love them.
And the mortgage-backed security is the whole salad.
Exactly. You blend it all up, and you sell shares of that blend. You're essentially betting that most of the fruit in that salad is going to be good, delicious fruit.
Okay, I'm kind of getting it. But our sources, they're hinting that Lehman Brothers, they maybe went a little heavy on the risky fruit, right? Like they were really betting on subprime mortgages.
Yeah, they definitely weren't afraid of a little risk. Subprime mortgages. Those are the loans they give to borrowers who might have, shall we say, a less than perfect credit history.
So kind of like hoping for a lot of those durian fruits in the mix, hoping they turn out to be the really expensive ones.
That's a good way to put it. Riskier, but potentially a much bigger payoff.
And they were really confident in this strategy, huh? Because I read somewhere that by 2007, Lehman had something like $85 billion in mortgage-related assets. That's insane.
It's a mind-boggling number. $85 billion, that's like maxing out your credit card 4 times over, hoping you hit the jackpot to pay it all back.
Okay, yeah. I think I see where this is going. Betting that much on something as unpredictable as the housing market? Yeah, that's starting to sound like a recipe for disaster. So last we left off, Lehman Brothers, they're sitting on this mountain of mortgage-backed securities, right? Some good, some, well, let's just say a little questionable.
A bit like a gamble, you could think.
Exactly. And they were betting big on the housing market staying strong, but we all know what happens next. The housing bubble, it bursts.
And not with a quiet little pop either. We're talking a full-on implosion.
So with everything going south, what were the final nails in the coffin for Lehman? Our sources, they point to a few key culprits here.
It's true. And I think the best way to understand it is like a domino effect. One thing it leads to another, and each decision makes the situation even more and more precarious.
Okay, so walk me through those dominoes. What was the first one to fall?
Leverage. It's a word you hear a lot in finance, but it can be a little, hard to grasp.
Yeah, I've definitely heard it thrown around, but I'll be honest, I'm not always sure I fully understand it.
So think of it this way. Imagine using a credit card to buy a house.
Okay, that's a pretty big credit card limit.
Right. Now, if house prices go up, you look like a genius. You've just made a huge profit.
All right, so I'm rich. I like this scenario.
But here's the catch. If house prices drop, well, you're on the hook for that entire mortgage, even if the house is now worth less than what you owe. That's leverage in a nutshell.
Okay, so it magnifies both the gains and the losses. And Lehman Brothers, I'm guessing they didn't exactly shy away from leverage.
Not at all. They were practically the poster child for high leverage. Something like 30 to 1, if you can believe it.
30 to 1. So for every dollar they actually had, they were borrowing 30.
You got it. Which means even a small drop in their investments could wipe them out completely.
Wow. Talk about high stakes. But it wasn't just leverage, was it? Our sources also mentioned something called short-term funding as a major problem for Lehman.
Right, right. So imagine this. You have a mortgage, right? But instead of paying it off over 30 years, you have to renew it every single day.
That sounds
I
stressful.
say the least. That constant pressure to find funding to make sure you can make those payments, that was Lehman's reality.
So they built this whole empire on shaky ground, basically.
In a way, yes. And they relied heavily on these short-term loans, which are fine if everything is going well. But when the markets get jittery, when people start to panic.
Everyone wants their money back, and suddenly there's not enough to go around.
Exactly. And that's exactly what happened when the subprime mortgage crisis hit. Investors got spooked, credit markets froze up, and those short-term loans Lehman depended on, gone. Just like that.
So they were building this tower of investments with borrowed money, relying on a constant flow of short-term loans to keep it all from collapsing. And when that flow dried up,
The whole thing came crashing down. But the thing about Lehman's collapse, it wasn't just about them.
right, this wasn't just one company's problem. It set off a chain reaction that was felt around the world.
Precisely. But I think we should save that part for after the break because how it all unfolded, well, let's just say it's a story in itself.
All right, so Lehman Brothers, this once mighty firm, they're bankrupt, the world is watching, and everyone is holding their breath. What happens next?
Well, it wasn't pretty.
I bet. Our financial system is all interconnected, right? So what were the consequences of Lehman's collapse?
Think of it like an ecosystem, right?
Mm.
In the financial world, everything's connected. Banks, they lend to each other. They rely on these complex webs of credit, of trust. And when Lehman went
It
down,
was like a shock to the whole system.
exactly, it was like pulling a thread that unravels the entire sweater. Suddenly, banks are terrified to lend to each other. Remember those short-term loans Lehman depended on?
Yeah, the ones that dried up overnight.
Exactly. Banks are looking around thinking, if Lehman can go bust, who's next?
Mm.
They didn't want to lend money to anyone, just in case, well, in case someone went belly up too.
So the whole system just froze.
Pretty much. It was like everyone slammed on the brakes at the same time. Credit markets froze. Businesses couldn't get the loans they needed to operate. People started losing their jobs. And the stock market, well, let's just say it wasn't a good time to check your portfolio.
Yeah, 2008, not a great year for the stock market.
Definitely not. And, this wasn't just some abstract financial crisis happening on Wall Street. It had a real impact on people's lives.
Absolutely. So when we hear about the 2008 financial crisis, the recession, all those economic woes, it all traces back, at least in part, to Lehman Brothers.
They were a major catalyst, without a doubt. Their collapse exposed just how fragile the whole system really was.
Wow. So a massive wake-up call, to say the least. But when the dust settled, did anything good come out of all this? Did we actually learn from our mistakes?
Well, you can't go back in time, right?
Yeah.
But you can definitely learn from your mistakes. And the Lehman collapse, that was a big one. It forced regulators to take a good hard look in the mirror, and it led to some pretty significant reforms in the financial world.
Like what? Give me the highlights.
Well, the big one is the Dodd-Frank Act.
The Dodd-Frank Act. Okay, honestly, that sounds a little dry, even for a financial regulation. What's the gist?
I hear you. It's not exactly the most captivating title, but bear with me. Think of it this way. Remember that tower of investments we talked about? The one built with all that borrowed money?
Diamond's Tower, yeah.
Yeah.
Destined to fall.
Right. Well, Dodd-Frank, it was an attempt to make sure those towers don't get so high, so wobbly in the first place. They brought in stricter rules about leverage, essentially forcing banks to keep more money in reserve, just in case.
So more padding, less risk of a total meltdown? Makes sense.
Exactly. And remember, those risky mortgage-backed securities, the ones with all those questionable mortgages in the mix, Dodd-Frank tried to address that too with something called the Volcker Rule. Basically, it limited banks' ability to gamble with their own money.
So less reckless betting with everyone's money. Good to know.
Right. It's like saying, look, you want to gamble, you can gamble with your own chips. But when you're playing with the whole casino's money, that's where we draw the line.
I like that analogy. So stricter rules, less risky business. That's the takeaway from Dodd-Frank.
That was the goal. But of course, it's never that simple, is it?
What do you mean?
Well, there's always debate,
Yeah.
right? Some people think Dodd-Frank didn't go far enough. They want even stricter regulations, more oversight. Others say too much regulation stifles innovation, makes it harder for businesses to grow.
So it's about finding that balance.
Exactly. And it's a conversation that's still ongoing. How much risk are we willing to tolerate in our financial system? How do we balance innovation with stability?
These are big questions, and I think that's what makes these deep dives so fascinating, so important. Because these aren't just abstract financial concepts, they affect all of us.
Absolutely. And they raise important questions about how we want our financial system to work, what kind of risks we're comfortable with as a society.
Lots to think about, for sure. Well, that wraps up our deep dive into the collapse of Lehman Brothers. From its humble beginnings in the cotton fields of Alabama to its spectacular fall from grace, it's a story about risk, ambition, and the far-reaching consequences of financial instability. Until next time, keep asking those tough questions.